Every time I look forward for this kind of calls where we can have interactive sessions, give you an update, give you our views, and also, of course, take your views. Uh, you know, so let me quickly, generally, broadly speaking, we try to cover a few things here, and post that we will get into Q&A. Uh, as usual, I think we will give you a quick update on our performance. What are the major entry and exit points here? I will probably spend less time on this, more time on given where people want to know markets and all. We will spend more time on that, and also we are reopening one of the strategy. I'll talk about that as well. Uh, so let's get to the update. Of course, last 1 month, 2 month, 3 month period have been very rough in terms of performance. Uh, when markets fall, of course, everything falls. And as you know that, while 12 months returns look good, but 1, 3, 6 months returns are kind of broadly negative. While you might outperform the market, but still negative returns are negative. Nobody likes that. But I think, like I said, these phases are also part of a long-term wealth creation journey. We do see these kind of phases do come in every once in a while in market cycles. Last couple of years, have been super from performance perspective. Still the long-term averages look pretty good, both from absolute return as well as our performance. Also, we tried to do that how our portfolios did perform from the peak of September 24, where markets kind of peaked out and till published returns of last month. And I'm happy to see that our portfolio outperformed even that drawdown period. All our compounder strategies, shift strategies, Amrita strategy, except YnG. YnG, of course, it was targeted to be a 15% return strategy, ended up giving almost 40% plus CSGR return. So last, sort of 6 months, it had rough patch in terms of underperformance. But again, like I said, long-term averages looks pretty good on that. But yeah, this peak to this performance has been kind of poor for YNG, but in general, it's turned out to be all right. Like we said, every time we look at qualitative aspect of the portfolio, which is faster, stronger, cheaper framework, that we keep on looking at the quality of our portfolio. So both on earnings growth, ROE of our portfolio continues to remain robust. PEG ratio continues to remain robust.
You need to share the screen.
Sorry,
You need to share the screen.
it's not shared. I'm sorry. I'm so sorry. I think there was no screen share. So my bad on that. And maybe I will probably take you back. I'm so sorry for this. But this is our performance slide. I did assume that I was sharing, but my bad on that. These are our 1 month, 3 months, 6 months return. Like I was saying, that we have had negative returns. We have had also to some extent underperformance in last 1, 3 months, specifically last 1 month. But 12 months basis through our long-term average basis, our performance is significantly higher, than the averages. Also, what we did was that we saw from September 26th of last year when the market peaked out, we how did our fund sort of do till last end. So if you see here, again, most of our funds have outperformed in this phase of downturn, uh, and except YNG, which anyway was the strategy, was designed as a contra strategy, and I'll talk about a little bit more. So in that phase, otherwise, I think it has done. Somebody seems to be playing on the screen. How, Tanay? Who's playing on? Sorry?
Go to more.
Yeah.
Disable annotation for
Yeah. Okay. Sure. Sorry for this. I just want to make sure that everything is. Is my screen visible?
Yes, very much.
Okay. So yeah, so I think in this period of downturn, I think till January 31st, portfolio showed good resilience. Also, we always focused on qualitative aspect of our portfolio, faster, stronger, cheaper, where we look at earnings growth, ROE, debt to equity ratio, PEG ratio. All of things I think are reasonably under control, good reflection. Portfolio betas have been lower than one. So all those things are good qualitative aspect of the portfolio, and I think that gives us reasonably good amount of comfort. Uh, some of the sector-wise allocation in the compounder strategy, BFSI, pharma, engineering are some of the large weights for us. Of course, IT has been one of our large. So these are the some of the weights in each of the portfolio, which I'm sure most of you know, see from the fact sheet as well. Same thing in Shift, which is primarily manufacturing and technology strategy. Pharma API has been our very large weight for quite some time. IT has been instead of 25% weight, we had taken it to 16% in the recent, I mean, last sort of 5, 6 months. Auto component, engineering goods, all continues to kind of deliver well. Amrit Kal, in this period, again, manufacturing is the largest weight there, which is combination of all auto component, pharma, engineering goods, everything manufacturing gets combined into this. BFSI is about 19.6%, services about 15%, consumption about 13%. Consumption, we've been, quite overweight this time around. Generally, we've been very, very underweight, but in this strategy, we've kind of picked a few consumption name, which has done well. So yeah, these are some of the sector weights in each of the portfolios. These are some of the stocks which I'm sure again, you get at the fact sheet, but Loras has been our very, very, large holding across its portfolios, and it has done well. This quarterly earnings was after 4 quarters, of awaiting. They delivered good numbers, which is basically reflection of again cyclic, good CDMO player. We've been believing in the management for quite some time, and contrary to the belief of the street, and it has paid us up very well in terms of the delivery of the numbers and of course performance of the stock. Biocon, we recently entered. Some of these portfolios are there in front, but let me just talk about a little bit more of our entries and exits. So this year we basically bought RBL Bank as a contra play. We bought Kotak Mahindra Bank first time. Our last 4 years, last 4 years we bought Kotak Mahindra Bank. We always believed that that bank was going to go through derating process, which is what happened. But I think now we feel the risk reward of valuation as well as the growth is falling in play. It's come close to 2.1 time book, where we think so we've taken fairly sizable bet on Kotak Mahindra Bank in this cycle, and we think over next 12 months, 12 to 24 months, it should do well. Structurally also, but generally specifically, it should catch up on the performance. RBL again, we basically the lot of negative is factored into the stock, and we see over next 6 to 12 months good turnaround possibility in terms of number. I think this quarter should be the last quarter of pain. After that, I think you'll see good turnaround and stock is available at 0.6 time book, and that was our thesis of buying. Uh, and we exited J&K Bank because we were switching off from one bank to another bank. So that was the only reason. Otherwise, J&K Bank continues to do well. KEC again, we switched because we were buying Kalpatru, and hence we switched because we were getting larger ticket. KEC was a small transaction, small size. So that's the reason we switched out. Biocon, we made entry this year, this last 2 months ago, and we think that in that company structurally growth is coming back. There's a Ozempic related growth. There is a CDMO growth. There's API growth. So I think that company we have kind of quite confident that after long underperformance, will do well. And some of the stocks we exited, some of them are very marginal position, and some of them like Eclux did very well for us. We bought at 1500 and sold at around 3500. When we saw growth slowing down, SP Apparel, same thing, bought at 4 500 rupees, sold at 1000 when we saw the growth was kind of still elusive. Ratnamani again, we had a great run, almost 4 5x since the time we bought, and we exited. CAI, I think stock disappointed us from the time we bought. I hardly delivered any return, and earnings didn't show up. So we waited for 4 quarters or almost 5 quarters, and we were not kind of quite confident in terms of anything immediately happening there. So we kind of sold it out. Amritkal, large positions are M&M, Kotak Mahindra, KEI, RBL, KPIL. So these are some of the large positions we have, and we sort of got. And exits again, VIP again, we exited, almost around the same price we bought because we couldn't see numbers were not so great. Bharti Airtel we exited as we believe that a lot of upside has been played out. And today, I think promoters also announced to sell about 8,000 crores of blocks. So we think that, I mean, it's again a good company, but, short term, we could see some playing out happening. Uh, in terms of earning growth, you know, Q3 has been so far not so great, at least for our portfolio companies. While I look at 9-month basis, it looks still decent, but Q3 has not been so great. And we're evaluating some of them, revisiting every bit of them, but some of the portfolio companies have kind of disappointed, which we expect Q4 of this year or, the next year should come back. But I must say that many of the companies kind of in this period not sort of lived up to the mark. But I guess that is a temporary phase. We are not worried about, at a by and large level that any major slowdown. But generally speaking, I think, this quarter was at least in some sense for us a bit of a disappointment. Um, Coming to the current market, this was about our portfolios and companies, but let us get to the current market, which I think is more of everybody's interest at this point in time. So, let us first set me in the context that, last 6 months, what was the environment, so we saw in last 6 months, a lot of liquidity is constrained in the system under the previous governor, while he did a fabulous job during the COVID and all, but I think he was too committed to protecting the rupee, and that led to significant liquidity deficit in the system, almost 350,000 crores of deficit, which was for quite some time very large amount, and that kind of started having a significant impact on this sort of entire banking sector and economy in general. There was a in general tightness of the money, and interest rates started kind of hardening because of liquidity. Secondly, I think government also slowed down payments and orders. I think last year we had elections, but that post-election also, by the time government came, so that first 6 months period, there was a huge amount of slowdown in terms of government spending. And that, of course, as we know, that government was one of the large spender in the economy, had huge, sort of ripple effect on the economy, and that led to a bit of a slowdown in the and so coincided with that were US elections were also there. So many companies were in some sense to face what to do, what not to do. Some decision making kind of slows down when there are big events in terms of and other thing was that there was a in last 1 year good systemic good stress was building in microfinance and unsecured loan, and some of we saw RBI nudging some of the NBFCs to sort of clean up that thing. And by and large, while it is not a systemic risk, but it had an impact on the entire banking system, and that banking system slowed down. So, say credit slows down. This is good in terms of from long term perspective, protecting the integrity of the system, asset quality of the system, so that it doesn't become systemic risk, but it does have impact on the growth. So if you see combination of many such, as all these issues started having impact on the corporate earnings, there was mixed sort of situation when we were chatting last quarter. There was a mixed view on the earnings growth, but at the same time, so last quarter we were not disappointed as much as this quarter. So it had a little bit of impact, in the earnings slowdown. Also, we saw last 12 months major capital raise. Every company was doing QIP. So a lot of paper supply was coming. So the entire market was kind of in that phase of some sense. So one can call it. The one side there was a tightening happening. Other side there were a lot of IPOs. Valuations were getting stretched. So all those things. This was the kind of character of the market, and which of course we have seen in last 1-2 months specifically. Leading to a bit of correction in the market. Uh, but so this is the backdrop of what market is, and We have seen Nifty correcting from almost 26,000 to close to 23,000, which is not a lot of correction, but in mid and small caps, we have seen much more corrections. Many stocks have corrected more than 30-40%. Many small and mid cap index has corrected 21-22%. So we've seen that correction happening, and I'll talk a little bit more about it. But let's, in this backdrop, but what is also happening in the market, very interestingly, we have seen major policy pivots happening. What macros I was talking about, which kind of vicissitude the environment or led to sort of this kind of situation. So RBI has done a major policy pivot. If you see under the new governor, the commentary has changed. He has taken many measures to improve the liquidity in the system. Already he's doing OMO and some of the other initiatives where the liquidity deficit comes back into the system. He has indicatively reduced the rate by 25 basis point. But the rate reduction does not mean anything because interest rates have not come down in the system because the supply was limited. So also, this governor has let the rupee depreciate. Previous governor was too much kind of in sort of protecting the rupee. And when you protect rupee, you basically sell dollar and suck out liquidity rupee from the system, and that also has impact. So I think this governor has less sort of this thing towards maintaining rupee very strong, and doesn't make sense also when dollar is strengthening. No point in losing rupee, creating liquidity tightness in the system, and you know protecting it. It doesn't make sense. So I think it's a good move according to me. It's a very major policy pivot which has happened, by the RBI. Also, very interesting thing is that earlier RBI had target-oriented approach that the inflation target was 4%. Now, basically range-oriented approach that they are okay within the range. It's not a target number that you have to reach to, and which I think is a very good situation in some sense, because ultimately, so it basically all means is that RBI is doing a major policy pivot from a kind of hawkish to dovish situation, and which I think is very good from a again macro perspective. Second, I think government also did a policy pivot in terms of major tax relief which government gave. Budget was a very good budget. If you see the dream budget come true, post that of course market has fallen, but budget directionally is very good. So much money has been given in the hands of individual taxpayer while continuing the path of consolidation. Right, government has continued the capex program. Also, I think there was a lot of noise about government did not increase significantly in the capex. According to me, see, the capex does not happen only from the government balance sheet, because when you are doing a lot of spend on infrastructure through PPP model, it is always off balance sheet also. So it's right now government has full focus in terms of continue to spend money on infrastructure and related capex. But so we are not very disappointed, as at least. Many people had this commentary on that. And also, I think this time around, government has tried to do a lot of significant measures on ease of doing business. They were in the fine prints, like, they did a very interesting change in terms of, which was a one pending block in terms of growth of GCC, Global Captive Centers, removing the permanent establishment clause. Now, that looks very small thing, but actually, it was a very big hindrance for many large companies to have massive operations of GCC here. So many companies you will see coming through, but these are all structural, not short term. One can get lost on the fine prints, but they have a very significant long term impact coming through. So like this, there were many such small changes which government had addressed in the policy. So your RBI pivot was good. Government pivot was also very good. Liquidity, I think we have had continued to remain strong flows on the equity side. January saw good flows from domestic investors. SIP continues to remain very robust. Uh, of course, FI continues to remain sellers. And our view on that, I think first of course, as the Trump sort of won and a lot of flow has moved back to US in general, overall AUM market flows are negative. But at the same time, if and this we have said historically also, whenever Fed is raising interest rates, it is very much linked to that. So whenever Fed is raising interest rates, money moves out of emerging markets, and that was happening over last 3 years or so. Emerging markets were getting outflows, and India being part of emerging market, we also lost a lot of money last year when in one month when Fed has cut interest rate. That time our flows turned positive. So I think any time interest rates starts coming down, you will see a lot of money coming towards back to emerging markets. Also, this year and last year, a lot of money within emerging market basket moved from India to China. And that also had, so a lot of people think that FI is a negative on India. It was only the reallocation and overall macro issue. It is not specific being negative on particular on India, right? Like if you see some of the large funds, sovereign fund, which has been investing into India for a very long time, are carrying highest ever exposure to India. Having Norges in Norway sovereign fund is very, very large, and they are carrying highest ever exposure to India. Same thing with ADIA, same thing with GIC. So, people, India dedicated funds are fairly growing. They are kind of continuing to invest money into that. Whichever, I mean, if you see Kotak has India dedicated fund, Nomura has India dedicated fund, all of them are growing. It is the emerging market fund which are kind of, sort of seeing this action in terms of outflows. And that, I think, in my opinion, will change materially only once, Fed interest rate starts coming down. In my opinion, it's a matter of time, whether it takes 3 months, 6 months, 9 months, I don't know, but it has to happen. And I think till then, probably we'll see similar kind of situation continuing. Also, I think if you see, last quarter we saw major downgrades, in the earnings. Now I think earnings downgrades have stopped. I think now that upgrade to downgrade ratio has improved. In next quarter, earning is expected to be better. If not, I think Q1 should be better. I do believe that these policy measures being taken tend to have impact with the lag. Like the tightness in the liquidity 3 4 quarters ago had impact on Q2 or Q3 of this year. They will improve with the lag. So I think that is what at least our conviction is, that you will start seeing earnings bouncing back in next year, right? If you see valuations again, partly with the time correction, as see when markets don't do well, markets remain. So partly with the value correction, partly with the time correction, Nifty starts becoming, or index starts becoming reasonable or cheaper. So today Nifty is trading at 19x 1 year forward, which is not very expensive as it's being opt out and as being made out. So if you see, we are pretty much close to historical averages. Of course, you can't talk. We can't see it going to 16, 17 time price to earning, in my opinion, because those were the very difficult markets, difficult macro environments for India. But today, Indian macro environment is fairly robust. So I think it's in the fair value range, and I don't see major downside coming to Nifty, from here. And also, if you see from some of the, this is a very interesting sort of slide. If you see, in Nifty 500, 300 stocks have covered more than 30%. 40 stocks have got more than 50%, 40%, 153 stocks. So we have seen fairly in the broader market, fairly large damage which has already taken place, in last sort of 6 months or so, and which is fairly significant, right? And if you see on the right hand side of the chart, there are many falls we just looked at, falls correction which happened from the previous highs and all. And if you see, whenever there was 20, 30% sort of fall, significant fall, of course, some of the 67% kind of falls are during financial crisis and the COVID ones, if I just kind of avoid that, you know, post that you usually see bounce backs, right? So, now whether bounce back we'll see from here, it will take 3 months, 6 months, I don't know. But I do believe that, 80, 90% of the damage is broadly done in the market. And now whether it is some bit more left, nobody can say that. The only thing one can say, there are no structural sort of issues at this point in time in the market. Other thing which to note is that greed and index fear, which usually monitor. Today, our fear index is fairly high, right? It has swung completely, and today very, very, environment. When you talk to participants, people, clients, it's reasonably fearful environment, cautious environment. And, in fact, some people are saying, are we seeing a 2008 kind of crisis brewing and stuff like that, which is very natural to have when, fear factor is high, because then you start imagining worse. Like when markets are doing well, people start believing that, it will continue forever. Same way, so market swings between greed and fear, right? So fear factor is fairly high. We have seen significant correction. Paper supply is slowed down. So all what was working against have started sort of turning. Valuations have fallen into place. Market cap to GDP has come down. but major policy pivots have happened. So I think all these things will sort of start playing with a bit of a lag. Now, whether that lag is 3 months, 4 months, 2 months, nobody knows, right? That nobody knows. But right now, markets have fallen, and in panic, everything falls, right? The good news is that there are no structural weaknesses, and I have spoken about in the past in our calls. Broadly speaking, deep corrections come only for 4 or 5 reasons, macro reasons, where when there are structural weaknesses, right? Whether it is fiscal deficit, whether it is current account deficit, or banking system weaknesses, or excessive leverage in the system, or highly inflationary environment, those kind of are structural weaknesses lead to very deep correction. Today, Indian macros are very solid, corporates are not levered, banking system is good. So generally speaking, there are no major sort of fault lines at the economy. So you will see a normal correction, which kind of got extended on the other side, which is right now under play. And in some sense, I again, it reminds me current market environment of very much similar to what we had in first half of 22. And I will remind you that 21 was a great year. 22nd half the recovery had started, but most people were not believer till late 21. And we saw in early 22, Ukraine war kind of started playing out, and we saw a good 17% correction. And I remember very much similar, concerns coming about. Mid and small cap corrected a lot. I remember chemical stocks had corrected almost 30-40%. Defense stocks had corrected. A lot of stocks had corrected significantly in that period. Inflationary fears were there. Geopolitical fears were there. So all kind of things were there, and very few people were kind of ready to sort of. And I remember we writing a note, which is there on the website, that embrace volatility and build this vintage, because this vintage will really do well, because ultimately, again, that time also fear factor was very high. People were not willing to engage on equities, and most people started investing into late 22. So I again continue to believe that this environment is very similar sounding like environment where the concerns around the tariff war is there. What will happen? Earnings are slowing down. But we are not seeing what pivots are happening, positives are happening, because markets are not supporting, prices are not supporting, and hence there's a lot more concern. And we saw post that period a great run in the markets. So I do feel that environment is very similar to like that, and we all need to be cognizant that in a long-term wealth creation cycle, these kind of phases do come, will come. There's no doubt about that, but there's no major worry point. As far as the economy is concerned, markets are concerned. And I remember last call pay we had said that risk always comes from unknown sources and unexpected sources, and when we don't. So this is the beauty of the risk, that you don't know, when it will come and how it will come. Nobody could have predicted this way it will fall, this quickly it will fall. But there's no one major reason one can point that this is the one reason it would have happened. When we were worried about tariff wars, and nothing has happened as far as India is concerned, but still, markets up. So I'm saying nobody can pinpoint this is the one reason why markets have fallen, right? There are many reasons, combination of multiple reasons, right? So only way to handle it is to prepare a quality of portfolio, continue to focus on the basic process and long-term approach. And there will be bad period, there will be good periods. In these kind of times, good stocks also fall a lot, because liquid and good stock, people sell what is liquid. Because there are many people who want to go on cash, there are many people who are margin funding calls. So all those things don't really sort of help good quality stocks as well. But the only faith is that if the management is good, business is good, eventually it will come back, and that is all you can do as an investor. Nothing beyond that, right? So finally, I think there, like I said, there will be all kinds of period in long wealth creation cycle market. Long-term success depends on how investors behave in these difficult times. Investing is a lot more behavioral than quantitative. In this time, whether you will lose now or you will kind of stay invested in the market is going to determine your sort of outcomes, from a long-term perspective. Next couple of months, in my opinion, whether it's 3 months or 4 months, will be period of increasing equity allocation. If you have cash and if you are fully deployed, you can just, sit tight and stay invested. I don't think it's a time to panic. There are no major sort of structural risks around. I repeat again, current market conditions will test patience for sure. Because every day, markets are falling, and investors keep start doubting that whether it is right. So this is the real test of long-term journey. And as the legendary Rakesh Jhunjhunwala once said, that to enjoy 10 bagger, you need to have the stomach to hold a stock while it halves, patience while it doubles, conviction while it doubles again, energy while it doubles again, and courage while it doubles again. So identify multi-baggers is easy, but real challenge is holding them through volatility. Because in a long-term wealth creation, stocks do tend to give up 30-40% corrections. Markets tend to give 20-30% corrections. It is very, very powerful course. It has happened in the past, it is happening now, and it will happen in the future. I don't know any period where markets will not be volatile, but how one behaves in these bad times, difficult times, is going to be determining the key outcome of the investors. One should lose now or continue to sort of. We are focusing on our processes. We keep on revisiting our portfolio. We are not saying we will not make mistakes. If we have mistakes, we'll correct them. Good news is that the entire market has fallen. If you want to switch also at a stock at a loss, you are again getting at another stock at a reasonable price. So it's not that we don't hold those biases that we will not book loss on any stock. We will continue to review, even if we have to sell a stock at a loss, but buy something else which is better. We don't have any challenge on that. We will act as appropriately if needed. Uh, so this is broadly about the market, how outlook we are thinking. And I also want to kind of briefly talk about this contra portfolio strategy. Many of you may be aware that around Ukraine war, like market environment was bad, most people were not looking to invest into equity. So we launched this strategy. That time we used to call it yield and growth strategy, and which basically I'm investing into companies where valuations were deeply in favor, 4 to 5% dividend yield, which will do well in an inflationary cycle. So where people didn't have belief, but you know, could do very well. And we guided that time investors that we will invest into companies with 4 to 5% dividend yield and 10 to 12% earning growth. That's the kind of, and we said one should expect in 3 years time about 15% kind of CAGR. Broadly we had sort of targeted in our investing. And as environment improved, we had closed that scheme for subscription. And that scheme has delivered over last 3 years roughly about 34% alpha, this after all correction and underperformance of last 6 months. Still, it has kind of delivered significant alpha to the market and more than our guidance to the market. Given, like I said, we are seeing a similar kind of environment, we decided to reopen that strategy. And also, we have repositioned that strategy as a Carnelian Contra Portfolio Strategy. And why we are repositioning? Because we wanted to, uh, 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 do a broader mandate on that, and I'll come to a minute. But given that we have a similar kind of environment, we think that this strategy will do again very well. So basically, we wanted to broaden. In the previous avatar of this strategy, we were looking largely only 5% dividend yield and some bit of a earning growth. But here we said, we will widen the strategy to include some other, basically structural growth story with temporary dislocations. What typically a lot of other contra possibilities are there. Businesses which are facing unfavorable business cycle. For example, cement right now is facing unfavorable business cycle, but eventually it will do well. Stocks with deep value, special situation which are available right now in the markets. So basically, we said, of course, the dividend yield will continue. So it's not only that, but that time it was every stock had to have dividend yield. But today we are also increasing, lesser dividend yield or more parts also in this. So this is the broader thought process around this strategy. And broadly speaking, the way number of the characteristics of the portfolio, 12 to 15% earning growth, ROE of 15%, debt to equity ratio should be. We anyway don't like much debt. So in our portfolio currently, anyway, there's no debt to equity of more than 0.5, but I'm generally we are seeing less than 1.5, where you can see largely turnaround margin expansion, some trigger which is there in the business over next 2-3 years. Also portfolio beta of less than 1. So well diversified portfolio and having these kind of characteristics which benefits in this kind of market where there's deep value. So like for example, I was talking about cement. cement stocks, industry has consolidated, has not done well at all in last 3 4 years, but demand is growing. It does well in stock function. So we think that, and pricing of the evaluations of the cement stocks are below replacement cost as well. So the incremental investment will not happen till the time there's attractiveness on the valuations. So we see that this is a good contra sector where I'm just giving some examples of what could be possible here. Again, chemicals could be very interesting contra bet. A lot of chemical companies are, while they have grown in revenue, margins have contracted and capacities have expanded. So, and I'm not saying chemical across the board. I mean, there are, of course, you have to identify company specific issues and all those things, but I'm generally saying, there are interesting contra plays available there. Banking, we think that last year did not do well. I think most stocks have corrected. The valuations have come down significantly, ranging company to company, but their business matrices have improved. No structural issues are there. So we find, and now with the policy pivot, we think that once the liquidity issues also get sorted out, it should do well. So some PSU banks are available even 0.6 time book. When some private banks are available much cheaper. So we'll look at some of those names these are just some of the examples I'm giving you, which could potentially find, way in this portfolio. Some special situation you will find where either there is an open offer or there is a demerger story playing out with the deep value. I mean, I can't talk about the names, but I mean, there are many which are right now there, which you could find interesting 40 50% upside over next 2 3 years. So basically have conservative approach and a lot of margin of safety and of course, we will not compromise on our quality framework. We will, if we are not convinced about management, we will not buy, but even if it is available cheap, even if it available contra, quality of the management is important for us. We'll do our forensic analysis and valuation. Like I said, margin of safety is very important in this. So we will continue to, we will definitely have that as a criteria. What are the potential risks in this? Essentially, like, reversal of cycle might take time. So let's say if cement does not play for next 6 months, it might happen that rest of the market might do well and cement continues to remain like that for another 6 months, 12 months, because precisely don't know which time it will start picking up. While you feel that the setup is right, but sometimes setup delays might take time. Like same thing when we bought in, during Ukraine time, we bought many stocks, but we did not know what time it will play out. But PFC that time, I remember, was available at like zero point 0.6, zero point 0.7 time book. And that time nobody wanted to kind of look at that. And that ended up delivering reasonably good return for us. Philips Carbon, I remember that time we bought at like 8% dividend yield, 8 times price to earning. And it ended up becoming 4x in last 3 years. I mean, 5x and I've corrected now, so almost 4x now. But, it did very well. So, but we had no idea when we bought that will become 4x. And we had no clarity that it will become 4x. But we knew the setup is right, risk reward is favorable, and it should do well. And so, in that sense, you might see that biggest risk is that since don't know have the clarity on the timing of things playing out, it might get delayed and might underperform in a various some of the little pockets. Here, idea is to look at absolute return that इसमें पैसा बनेगा कि नहीं बनेगा. That's the kind of approach, broadly speaking. But the risk factor remains that sometimes you might run those risks. So yeah, so this is the strategy where we're opening for the flows now, but if you need more details, please reach out to us. And now I'm happy to sort of take questions. You can, if you have a questions, please feel free to raise hand. Otherwise, I'll read from the chat, of course. But I'll just pick up some questions which are there from the chat. I think how many years over? Normally, how many years of the performance is paired with the PMS competitor like 3 years, 5 years since inception, which many years are. So I think performance comparison has to be done 3 to 5 years, according to me. I don't know any fund manager, portfolio manager who has not gone through period of underperformance. And it will happen for everybody, and I'm sure it'll happen for us also sometime. But generally speaking, I think 3 to 5 years. I think anybody who outperforms consistently market by 3 to 4% is a great number, according to me. From a long-term perspective. So somebody has written on RBL the thesis. So I think I think somebody has, my views, but anyway, you outlined your the views on RBL very well. But reason why we bought, I think we like the new MD who's been kind of leading this turnaround. He has focused a lot. I mean, of course, microfinance was a challenge which they have taken most of the, knock and write off. It's available at 0.6 time book. They were, he's focusing on, so when you have the good risk reward happening and the management focusing on, getting the profitability back, there are no structural issues in the bank per se. Cost to income, they are bringing it down. So in some sense, it reminded me of very similar to when we saw Indostar when we bought at around 0.3, 0.4 time book. So you have risk reward in your favor. Plus, we think that the new management and the CEO just got the renewal of his term. I think is very much focused in turning around or making it happen. So that's the reason we liked it. Uh, we are positioned on safe strategy. I don't know what does that mean, but what's your the gold for next 6 months? I have no idea. Honestly, I'm no expert on gold, but according to me, gold should be peaking out. But again, I have no idea. Uh, Portfolio is down, 9% monthly key. I think again, like markets are down, so I am sure, most portfolio. I mean, because wherever depending on which portfolio, but mid and small caps are down, so you cannot escape. If it is, if it is. Markets are down, you will be down. So that's a sort of many stocks which we feel like are down, and we have no idea why they are down. So those things will happen. Let me take some question from the people who are raising hand. Uday, why don't you unmute and Uday, please go ahead.
Hi, Vikas, Uday here from Bangalore. Am I audible?
Yeah.
So thanks for the wonderful PPT. I always pleasure listening to you actually. So I follow all your social media videos, everything. So I have a quick question on whatever you have covered. So not on the portfolio performance or on the some of the stocks I've seen that 30-40% down, but that's part of the nature of the beast. So the question is on the earnings. I think the projected earnings are in the vicinity of 20%. So very good to see that. But when you presented the Q3 earnings of the portfolios, the various portfolios, they were in the vicinity of 10% or so. Even on the 9-month earnings, they are at 10% or low double digit. So that is that a concern, Vikas? If you can throw some light on that.
See, look again, like I said, when you project broadly earning, it is a combination of many things, and you're right. Things may or may not played out, and that projection is obviously when you're investing with some sort of hypothesis and why that will go there, right? And there
Sure.
could be sensitivity to that, and that's the reason when we saw this quarter numbers were not up to the mark, that's where there's a disappointment. But I think, see, one thing I can tell you, I run a business. I can't tell you what will be my next quarterly profit. So how anybody can say what will be profit over next 2 3 years? It is just broadly, indicating based on the hypothesis how it can get there. But if it gets there, what will be the outcome? Right? You are basically investing based on hypothesis and making your models that these are the various vectors, but vectors can change. Like I said, if the liquidity changes, macro things change, output will also change. So I think those things will have to. So currently we just revisited most of our portfolio. This is what it was, but it is a continuous process of revisiting. It might happen that we might have to bring it down our estimates, but this is right now. At least it was. I think this was about a month ago exercise. We keep doing this time and again. It's not like daily basis, but we keep doing it periodically, and potential possibility that it might sort of come down also. It depends really on how the tailwind comes out on the environment. Good news is that there's a base effect of this year is lower. So, to that extent, the next year growth could be better.
Sure, sure. Thanks. And I think the other good point you have highlighted, a lot of the pivotal shifts like RBI cutting rates, all of that, I think people are not still recognizing it. That's a very good point. So that's very good for the markets. Thanks, Vikas. Thanks for the opportunity. Thanks for taking my question. Bye.
All right, thanks. Rajesh, please go ahead.
हेलो विकास सर, मैं जानना चाहता हूँ सर, ये जो इंडियन रुपी अभी
You're not audible.
सर, आई वांट टू नो दैट इंडियन रुपी is depreciating against US
No, you're not
dollar.
audible. I think you are probably on a speaker phone, or if you can speak closer.
Hello, sorry sir, I'm not I'm audible now.
Yeah.
Sir, I need to know that Indian rupee is depreciating continuously against US dollar, and as per market में ऐसे सुना जा रहा है कि वो 88-90 तक भी जा सकता है. एंड सेकेंडली, प्रेसिडेंट ट्रम्प जो टैरिफ्स लगाने की प्लानिंग कर रहे हैं, जो सुना जा रहा है, तो इन दो चीज़ों से क्या मार्केट यहाँ से और नेगेटिव जोन में नीचे जा सकता है कि इसका प्रभाव यहाँ इस स्टेज पे मार्केट जो 15-20% गिर चुका है, तो यहाँ पे इन चीज़ों का क्या इस पे असर हो सकता है, मैं ये जानना चाहता था.
So I think सर रुपी जो है वो आई थिंक जैसा मैंने बताया कि इट इज मोर देन रुपी depreciating, it is dollar appreciating trade. See, rupee is not depreciating against euro and other currency, but more dollar because of the US Trump outcome, and a lot of money is going back to US, and also because of tariff thing, right? So, earlier, RBI was protecting that, but now I think RBI is kind of letting it go, and it makes sense according to me. So I think rupee can further depreciate. Again, really depends on how flow comes out and all. But at least today we know that RBI is not out going to defend rupee, and that's the good news. Rahi baat Trump tariff and all those things, according to me, it's not a very significant item as far as the India is concerned. But we will only know because the total Trump on the total $50 billion deficit US has, you know, India, when they are talking about reciprocal tariffs, the total import duty in US on Indian goods is 3%. In India, it is 10% on US exports to India. So it's not a lot of difference. Of course, internal to some sectors, there could be differentials, like where, let's say, on some, Harley Davidson, there's a high duty. Those kind of things can happen. Pharmaceutical US can increase duty, but according to me, this is less likely to be disruptive. Like India is largest exporter of pharma to US. Now, there's no other alternative to US from pharma perspective. India has 45% market share in US medicine. Now, if they put more tariff, it will be passed on because it's not that suddenly you can replace your 45% market share to somewhere else, right? And pharma sector in US is, 2 years ago, FDA regulator had come to India uh, to kind of outreach Indian pharma companies because Indian pharma companies had stopped investing into US based pharma because the pricing competition was too high, and they had come to kind of engage with companies and all those things because there was shortage of medicines in US. So I think there are a lot of other intended consequences. We will know only, but I do not see as a major disruptive. According to me, it's a kind of tactic by the Trump to kind of negotiate, doing some things on table and do. So I don't see really it's as a very big. Of course, we'll have to keep it. I mean, I'm not an expert in terms of politics that what Trump will do, but probably from the where we stand, to me, it looks like that's not going to be a major disruptive thing. And anyway, he's generally been nothing came out from the major negative from the recent US Modi trip to US. Uh, if at all, I feel probably it was slightly positive, but that only we will know as the final over next 6 months. They say we will negotiate, work out the details. But given the relationship between Modi and Trump, I think there should be neutral to positive outcome, not negative outcome. Mihir, Mahisha.
Yeah, so can you hear me?
Yeah.
First of all, thank you for having such a wonderful session. It's always a pleasure to hear from you. My only question is, so like what sectors do you see benefiting from this year's budget? Like from the consumption basket, do you see QSRs having a comeback, or is it autos? Is it FMCG? Like, I would just like to hear your thoughts on it.
I don't think, if you ask me, I'm not a big believer that because so much money is given to, I mean, we don't know that which sector in consumer will go. See, whatever 12 lakhs has been left, it could partly go to repay loans, it could go to deposit, it could go for investments. So I think I'm not saying that based on this thing, we will just generally go and buy consumption stocks. I think it boils down to again looking at companies and how the trends come out. If at all one has to make this thing, I think discretionary consumer discretion might see some uptick. But again, just because of that, you can't buy stocks because then you have to see the within that sector competitive intensity. How so companies have to be evaluated. Generally speaking, consumer discretionary spend should go up. But again, one has to kind of look at individual stories and stocks. Shriram, Ajay Dikshit, please go ahead. I think I would request if you can quickly come because then it will save everybody's time. I would appreciate that, please. Ajay? Okay, I'll move to Nihar. Nihar, uh, Mayank?
Hello, Vikas, can you hear me?
Yeah.
Yeah, so Vikas, I'm an investor in the shift strategy. In your slide on market outlook, you highlighted some of the risks, and you mentioned that the PMS was aware of some of the risks, as well as there was a wide consensus in the market regarding the valuations, high valuations in the small and mid cap. Having said this, what was the rationale of PMS to continue investing into mid and small companies, particularly for an investor like me who is going into STP mode? Um, in contrast, was this possible for PMS to advise, to stay in cash for an investor like me for a while?
See, investors do their allocation, give us the money, and then we invest, right? And shift strategy mandate is mid and small cap, and especially in manufacturing and technology. Like I said that, in any journey, there will be bad periods and good periods. But fact that, over the years, it has consistently delivered outcomes. And I'm sure, like in 22 also, by the way, we had a bad phase in the same shift strategy. But eventually it came and kind of, so whatever adjustment needs to be done, one can do. But sitting on cash and not cash is the investor call, right? We don't take much cash call. Maybe we can do 5-6% cash call. So like last 3 months, whatever money we were getting, we've been deploying very slowly. In fact, we were sitting on almost 40-50% cash for a very long time on many, recent money. In fact, investors used to ask, why are you not investing when we are giving you money? So because we were kind of cautious and we were buying only stocks where we were comfortable. But we don't generally kind of create cash calls saying, because it can backfire both sides. So we don't do those aggressive cash calls. And I think long-term journey, if you ask me again, like I was saying that, and again, it makes sense to kind of stay invested through thick and thin. Smriti?
Hi, Vikas. Great session. I have two questions. One is on Spark. What will be the effect on that company looking at the tariff coming in from US and your views on Borosil? And the second part of my question is that how long do you see this pain before it recovers to the August-September levels of 2024?
I mean, I wish I had the second question. I wish I had that answer. Like I said, I was pointing towards some of the measures which has been taken, pivots which have happened should be positive. Now, sometimes it might take 3 months, sometimes it might take 6 months. Honestly speaking, nobody is an answer. And like I said, I feel that given where the market mood and sentiment has shifted, it might take, maybe 3 to 6 months. But I have seen moods change very quickly also. So it really depends on how things pan out tomorrow. Let's say I feel that big trigger will come in markets globally, not only in India, when the Fed starts cutting rates, right? And if that happens, I'm telling you, everybody will be thinking very differently. Now, whether that happens in 3 months, 6 months, I have no idea. So I think a lot of things depends on markets change. mood changes very quickly. Right now, I know that it is completely shifted towards, as I was showing that, towards the fear. And so let's see. Borosil, I think we've been positive. I think it's a great company run by good management. I mean, and they've done well. Last quarterly earnings were very good. So I mean, again, nothing negative in the company, but market price tend to correct. For many reasons. There is good earning growth expected there, uh, and great product portfolio. So, and we like the company and management both. So we remain invested.
What about Spark?
Spark, the pharma one.
Yes.
So Spark is a very innovative company in the sense that it's not a usual pharma company. It's focusing on innovator drug. Now it's one of those companies where the payoffs are binary in the sense like if one drug gets hit, in my opinion, the stock will not be available on upper circuit for next 20 sessions because that's the kind of impact it will have. Each drug could be worth $5-10 billion, right? So it's one of those that stock has to be looked at and it has no impact on tariffs or no tariffs because if the drug gets successful then it is a huge outcome. So yeah. Um, Shyam, I think we'll restrict. I will take some questions.
Hi Vikas, thanks for the session. It was nice to hear you. Vikas, just only one question. What's the strategy you would have for a fresh investor? Suppose client wants to come up with like he wants to commit 100 rupees. How much you are comfortable to accept right now?
See, look again, allocation. I mean, we will, of course, we've been investing slowly. We will, but I think right now where the opportunities are coming, we might not be very slow in deploying because we think that, 80-90% of damage is done. So allocation, I think investors decide whether you do SIP over 3 months, 2 months, 1 month, or 6 months. That's up to the call of the investor. I would say from now till June, July, I think this vintage will be good. Now, of course, everybody has to keep watching, how the variables are developing. But I would say that I'll be surprised if Nifty breaks 22,000, 22,500. Uh, with I mean, in fact, I'm not very, I don't see too much downside from here. Now, what pace to deploy? Again, it's the investor one has to take call because ultimately you have to hold the now. So,
Yeah. Thank you. Thanks.
Ajay, Nihar,
Yeah. Hello. Yeah. Yeah, Vikas. Can you hear me?
yeah, yeah, yeah.
Yeah. Actually, I have got two questions. The first question is, as you rightly said, the FPIs are pulling out the money. But when you see all the emerging markets, South Korea or other emerging markets, they are not. I mean, they are not getting hampered that much. However, most of the money is being pulled out from India. There is a disparity, I believe. If you and the second question is you know, uh, at these high valuations, do you think that the dollar yield is the only reason that the FPIs are pulling out? They're getting a good value there because of rupee depreciation, or they're getting good liquidity here. Domestic institutional investors they are buying out. That's why they're getting good exit. So, is that the reason why the FPIs are pulling out? These two questions.
I think I explained the same thing in detail. And India is actually receiving less outflow than other emerging markets, except last 6 months where the reallocation happened back to China. If you see
Yeah.
last 2 years, India was actually least impacted, by the emerging market outflows on a relative basis. So, of course, if a lot of money goes out, it will go out from India as well. So.
Exactly what is happening. A lot of money is going out because the other economies like Singapore, Thailand, and other economies they are not getting hampered that much. Yeah.
I'm not expert on other economies to comment, but if you study emerging market flows, you will find some patterns.
Yeah. Yeah.
Omkar? Okay. Varun, quickly. I'll just take some questions from the chat if there are some interesting
Yeah.
ones.
Hi, Vikas. Rathin here. Thank you so much for the presentation.
Yeah. Hi.
Yeah. So I was just referring to the PEG ratio, which seems to hover around 1x for the Bharat Amritkal and 1.3x for the structural shift. Now, this is based on FY27 earnings growth, or is this more long-term in nature?
27 growth, yeah.
So I was just wondering, would it be relevant to look at a more a longer horizon, say 5 to 8 years, so we iron out any short-term fluctuations while looking at PEG?
So say 2 years is also, I mean, see, you can look at any period, but how do I know what will be the earning growth of 5 years when we can't even be sure for 2 years? These are all estimates, you based on certain, inputs you see on the industry and the company and management, what is the capex they are doing. I mean, so 5 years is very hard, in my opinion, to predict anything. And you're not anyway able to predict, to be honest. These are just, you're trying to see if this company can grow and all you can do is, growth range. You can never say it will grow at 25%. You can say it will grow between 20 to 25%. But since you have to do a number, you have to put a number and arrive at something. So it's never, and again, I'm telling you, it is impossible for anybody predict precisely anybody's number. I can't do for my business, forget what I will do for other businesses. So just these are more indication than actually, if you ask me, I think.
So basically, I was referring to more historical figures, say 19 to 27, to look at a long-term range, what the sustainable earnings is like.
Sustainable earning growth, generally speaking, I think in India should be between 14 to 15%. For if you take, 5-10 year view. Now, within that, some companies will do well, some companies will outperform, some sectors will do well, and there will be different periods. So, but that should be sustainable range.
Sure. Thanks.
I'll just take some few questions from the chat. Why you are saying it's absolute for the contra strategy? There is a question by Mai Kumar that why, given it's a long-term product, are you looking to do month-on-month performance like an absolute return product? So again, the here idea is to say that we are approaching with the absolute mindset. I'm saying whichever way one evaluates. When we launched YnG, that time also said mindset is the absolute return that can we make about 50-60% return in 3 years' time. That was a way of evaluation. Eventually, evaluation of idea. Eventually, how you compare it with others. I mean, it can underperform index, it can outperform index. That's possible, right? So, which is the reason why we are highlighting that here our evaluation will be, and that practically is so here biggest differentiator. We are looking for a lot of margin of safety, on the valuation and the contra plays. So one has to constantly keep in mind contra plays are different than the growth plays. In growth plays you will consider differently versus contra play. In growth plays, you have to have the path of the growth visible to you. In contra play, it may not be necessarily visible to you that which quarter, but you know that, like I said, cement, you know that, it will do, but whether it will do in 6 months, 12 months, 2 years, no, we don't know. But risk reward is in favor. Huge value, margin of safety is there in valuation. So that is what we meant by, will you make relatively better in the market? I don't know. Will it do absolute return? Absolute return? Answer is yes. That is how it should be seen. What the mid-sized private banks like Indus and RBL IDFC looking from here risk reward? I think I commented on that. I would refrain from individual stocks. Overlap between shift and contra strategy will be very limited. There could be some, but will be very, very limited. I don't think there should be other. Shift is very growth-oriented strategy. Contra is not as much growth-oriented. I mean, it's more contra. So I mean, there could be one or two stocks. I will find it very. There won't be many stocks for sure. Shift versus contra, again, both are very different mandate. Chirag, you can decide. I mean, shift is more manufacturing technology, slightly expensive, long-term oriented, mid and small cap. Contra is more large cap oriented. 50 to 60% will be large cap, balance in mid cap. So based on your risk reward appetite, I think you can look at whichever you like. I've pretty much covered most of the questions. So I think Abhilash, I have one or two questions I'll take from the Abhilash. Please go ahead. Omkar?
Yeah,
Yes,
good evening,
Abhilash.
sir. So, like on the long term, the returns are a function of earnings growth. So, have you had any analysis done on your current shift portfolio and compounder, wherein this quarter, year on year, what is the earnings growth like for all the set of companies?
Sorry, Abhilash, can you speak a little louder and clear?
Yeah. Sir, I was asking that in the shift and compounder strategy, have you done any data analysis of the earnings growth year on year after this quarter? Because most of the companies have posted the results, right?
I had
Uh,
shown that I think you missed it. I had shown in the slide that 9 months results were decent, but last Q3 was not so good. I had shown that.
oh, that is your set of companies. Like,
Yeah, yeah, yeah,
yeah,
yeah.
okay.
Omkar?
Hello, am I audible?
Yeah, Omkar, yeah.
Sir, I wanted to understand the rationale behind investing in Aditya Birla Capital.
Aditya Birla Capital, again, in NBFC business, we like, I think our biggest criteria was in NBFC business, we like AAA rated NBFC because liability side is the most important, which is what it is. It borrows the same cost as Bajaj Finance. Plus, CEO is very good. Vishakha came from ICICI Bank. She did very well in terms of uh, she's kind of putting the company on a high growth trajectory. Also, valuations are reasonably even. I mean, stock has corrected significantly, and honestly, I have no idea why. But to give you an idea, this year it will do 4,000 crores of PAT, and market cap is around 35-40,000 crores. So, with 15% plus ROE, good franchise businesses, no major stress on anything, growing well. So I think there's a deep, in my opinion, good value there, and good growth is also there. So risk rewards in favor, and we don't see any reason why this will trade here. But markets can sometimes ignore some of the underlying changes happening in the company. So we are very, very bullish on that.
Okay, and my second question was, you said कि whenever the Fed will cut the interest rate, you will see huge amount of inflows in emerging markets. But as of now, I think US Fed has cut interest rate by 1%, but we haven't seen any kind of inflows in emerging markets. Plus, if US markets are giving such a solid returns and even rupees depreciating, so why would FIIs would want to come in India? And what's your view on?
I think when last time cut, we had seen inflows last year, but then again, US yield tightened back, and because of their economic situation. So that's the reason. Uh, you know, uh, that's the reason. Again, you saw outflow happening. So yeah, but I guess decisively again, when the Fed turns dovish, this should happen rather.
Thank you.
I think we have literally run out of time now. We've overextended by 15 minutes. I know there are lots more questions, but you'll have to pardon me this time round uh, because I have another meeting at 5:15. So we'll definitely thank you very much for joining.